Here we are. Thank you for joining us on the Leaders in Housing Counseling call that we're doing, first one in November. Glad to have you. We have a pretty crowded agenda and a lot of people participating from across the country, so this should be an interesting one for all of us. We're going to do an overview on legislative activities. Melody will give us her perspective on what's happening in DC and our next steps. I think we posted a little bit about this, that the THUD staff, the Senate staff, who are the people who deal with the budget issues, after a meeting with us, wanted to learn more about housing counseling, and that ended up being a visit to NCRC to do a deeper dive into what housing counseling is and how it works, and answer questions. Ibajoki Akinwale from NCRC represented all of us in this, so we'd love to get a rundown of how that meeting went. HUD was in the meeting as well on the Office of Housing Counseling, but I think what she learned is helpful for all of us to hear, so I wanted to make sure that she gave you her rundown on that. So we'll spend a few minutes on that, and most of the call will be on the main theme for today, which is this whole question about thinking about agencies potentially merging, or maybe doing partnerships or consolidating. There's a variety of different models, and what we have are area experts of people who are in different stages of doing this and trials, and have deep information both about what can be done and maybe watching out for mistakes of things that we want to avoid in thinking about all these. But an important subject for us, one partly because these are happening in our world, but also it's a recognition that that in a world of tight funding, that this consolidation may allow us to have lower operating costs overall and be able to have a broader set of services that agencies provide as a result. So I think we'll all learn a lot from this, and looking forward to it. We will also have our usual plug for NHRC membership, and encourage people to join. We have done, we're continuing to bring in new members this year, so that was great, and groups are renewing, and we really appreciate that. It's what keeps us going. Our next call will be on the 21st, and we're still working on the topic, but we have a couple very interesting opportunities. We'll see which one comes to the top. So with that note, let's move on to Congress and Melody.
Thank you, everyone. It's been fairly busy. There's a lot of moving pieces currently on the Hill between the two bills I'm about to discuss, as well as appropriations. I'll try to move through them as quickly as possible. If you have any questions, please use the question feature in the display. So for the Community Development Block Grant Disaster Recovery, NHRC has been following this very closely. We support the bill. There's a lot of bipartisan support in both chambers for it. On the House side, the bill already passed Financial Services Committee, and we thought it was going to hit the floor, House floor, for a vote, but then they sort of reached a roadblock because the National Home Builders Association had some disagreements with the mitigation provisions in the legislation. So Transportation and Infrastructure, which is the T&I committee, House Financial Services Committee, and then House leadership, Democrat and Republican, worked really closely with the National Home Builders Association to sort of work out their disagreements with the legislation. Apparently, as of today, we heard that was addressed and they've come to a consensus. So the bill has been rescheduled to hit the House floor in 2 weeks or so for a vote, which is really exciting. On the Senate side, the bill was introduced by Courtney Young, I believe this summer. And we're still working with Senate offices to sort of increase GOP co-sponsors. What we've heard directly from Senate Banking Committee staff is that while there is interest in the bill and it could be heard by the Banking Committee, which is the Committee of Jurisdiction for Legislation, the chairman, Chairman Crapo, wants more Republican co-sponsors to build support for it. So this Courtney Young bill, we've talked with a lot of great offices We've talked to Kramer in North Dakota. We've talked to Senator Scott from South Carolina. We've talked to Senator Rubio from Florida and other offices, and we're trying to make the case for the bill. We just found out today, though, that there is a second community development block grant disaster recovery bill that's been introduced by Senators Tillis and Senator Burr. This bill, according to the National Low Income Housing Coalition, as they recently reviewed it, it does not include a lot of the provisions that were encouraged in the Schatz and Young bill. So, for instance, it does not require that recovery dollars are spent equitably between homeowners, renters, and people experiencing homelessness. They removed the provision on data transparency and mitigation standards, and they also removed measures to ensure compliance with civil rights protections. Beyond those provisions, it's the exact same language from the Schatz and Young bill. So we believe that what the best option moving forward is that we still talk with Burr and Tillis about the legislation, preferably the Schatz-Young version, and encourage them to sponsor that version of the disaster recovery bill. And the National Low Income Housing Coalition has heard that their offices are open to that possibility. So we're reviewing updates on that, and we'll keep everyone posted. On the Housing Financial Literacy Act, we had a really good conversation with Senator Peters' office. They have a new staffer handling the legislation. Forgive me, the name is escaping me, but I'll definitely send out correspondence regarding that person for outreach. We feel confident that the support for the bill is progressing. We have really good conversations with Senator McSally's office, and they've touched base with Senator Peters' staff. They have a few kinks they want to work out in the legislation overall, but we're confident that the bill is moving closer to being introduced, although there's no timeline on that so far. And of course, we'll keep everyone posted on where those bills go. Moving on to fiscal year 2020 appropriations, the hot topic on all agencies' minds. I sent out to the listserv, I believe, a week and a half ago that the Senate passed the fiscal year 2020 THUD bill that has the housing counseling program at $45 million, which is really disappointing. We worked really closely with the committee and different legislators across the Senate, hoping to get them to the House figure of $60 million. But the Senate THUD appropriation staff felt justified in their number, which Ibi Joke would elaborate on during her portion of the call. We're hearing now that conference committees could be delayed due to the biggest issue affecting Congress right now, which is the impeachment inquiries and hearings for President Trump. So we're watching that pretty closely. What we're hearing, though, is that due to these hearings, people aren't as confident about how the White House will go around appropriations. And so we're currently hearing that we may have a shutdown or another continuing resolution, which currently funds the government through November 21st. But if they pass another one, it may go through December or even January or February. We're hearing that we shouldn't expect, any conference committees around the THUD bill or other appropriations bills that have passed both chambers until they potentially have a real conference discussion around the 302B allocations, which is the allocations that fund each appropriations bill. They usually have a sum total, and then they break it down by program following that. NHRC is working really closely with our partners in the field to sort of coordinate efforts, and our goal is ultimately to have a higher figure for the program. Ideally, we would be able to have it at $60 million, which is the House figure, but given how low the Senate number is, it's just working from a much lower floor. But we'll keep everyone in the loop about that. We're confident that we're going to be able to have robust discussions, but given the previous appropriations season, everything is sort of unpredictable at this point. So we'll see how that goes. And with that, I'll turn it over back to Bruce.
Excellent. Thank you so much. Let's quickly move over to the recent visit of the THUD committee staff. Oops, we missed a slide here. There we go. Thank you.
That's my fault, everyone. I apologize.
All right. So so the TED subcommittee wanted to learn more about housing counseling. We connected them actually with Sarah Jarik a while ago, and part of that was that they wanted to do a site visit, and NCRC was the agency that represented all of us in this discussion. And so Ibajoki was the key person in all this at NCRC. So Ibajoki, are you with us here?
I am, Bruce. Thank you.
We would love to hear how it went. Tell us what it was like and what we learned.
Great. So I'll first start by saying we did our best to represent all of you and the hard work that happens across the country through the various organizations as best as possible. So let me tell you who participated in this meeting. We had representation from Senate Majority and Senate Minority staffers, Courtney Young and Christina Moore. From HUD, we had members of the CFO's office, and out of the Office of Housing Counseling joining us, Danbury Carmen, Acting Deputy Assistant Secretary, and Ruth Roman. We also had a representative from Brian Montgomery's office in the room as well. So overall, our goal for the conversation was really to draw the connection between the recent allocations and the big pot of money that we've been missing, which is the NSMC dollars. As we know, since 2008, over $853 million have been allocated for those funds that have really offset the expenses with the HUD dollars throughout the years. And since that funding has gone away, a lot of housing counseling agencies have relied strongly on the HUD dollars, despite not seeing any increase in that allocation. So we talked a bit about that with that team, and also wanted to draw in the correlation between the decrease in funds, the exit of the NSMC dollars, now causing a decrease in housing counseling agencies across the country. A question that was prompted to us from Christina Young was there any correlation or connection to the HUD certification exam requirement causing a decrease in housing counseling agencies? And so we continued again to draw back in on the need for additional funds. There was some assumption that the $45 million was enough to sustain housing counseling agencies. And so they directly asked, was it enough money? And we let them know that it was not, and that we hadn't seen increased commitment from them to help fill the gaps of the funding that we are missing from the market. A question that they posed to us was, are the banks filling in and plugging holes where need be? We acknowledge some of the philanthropic efforts by some of the widely shared banking partners, but it's still that housing counseling agencies was looking for additional allocations from HUD and to seeing an increase in that regard. A question and comment that came from Courtney Young was about confusion about how folks learn about housing counseling, how folks connect to housing counseling agencies, and that there were significant comments made about members being overwhelmingly more familiar with CDBG, home, and the voucher programs, and having a lack of knowledge of housing counseling, how it works, and how their consumers and constituents can connect to it. And so they did identify what did seem to be a little cumbersome, and just they're trying to figure out through their various online searches and trying to figure out ways to connect consumers to housing counseling agencies, because they weren't really clear of what the proper channels were in order to do so. And so one recommendation, or the biggest takeaway that we all left from that meeting with, was that they enjoyed the letters. They appreciated the sign-on letters. I know many of us have signed on to NHRC's letters, but what they did say is that they were looking to hear more diversification in our outreach to various members on the topic of housing counseling. And so they mentioned that members want to hear from housing counseling agencies in their states, in their districts, and they want to hear from clients as well. And so, again, we walked away from that meeting feeling confident that the letters do work, that they are interested in hearing more directly from state representation. I think we all left taking away how we could better coordinate housing counseling agencies in the Maine area, to do some outreach to Susan Collins' office, and so on. One thing that came up as well, I think my final comment here, was on a disaster recovery. They widely understood that the CDBG DR funds had their delays. They did not understand that it may also play a factor in terms of the comprehensive housing counseling funds, and organizations that are in those disaster impacted areas spending through those dollars a little bit more quickly because of the increase in demand in light of a disaster. They acknowledged that they had not made this correlation, and that they would need to hear more on it from local housing counseling orgs. So again, I think our takeaway in general was they appreciate the letters. They would like to see more letters to all of the members of the committee in their states, client letters, and things of that nature. I do know that NHRC and NCRC will have some sign-on letters. While we've acknowledged, and Bruce will probably speak a little bit more on this, that given some of the excitement or attraction around impeachment and a lot of the unpredictability that's happening there, that now might not be the best time to draft said letters. But I will say that the time will soon come where, as a community, we will mobilize your efforts to reach those members and telling the story of housing counseling and how it is impacting clients on a local level. And I'll turn it back over to you, Bruce.
That was perfect. Thank you so much. I mean, this is such a valuable thing, and making it concrete to people is part of what we have to do routinely. And so Courtney Young works for Susan Collins, so the Republican, the majority party in Senate, and Christina, what's her last name? Moore?
Christina Monroe is
Monroe,
counsel.
So she's for.
You can go.
For Jack Reed, who's the Democratic, the minority representation out of Rhode Island. So, I mean, what's valuable about this is that it's part of that. Well, I think that the big message here is that while they hear a lot more about CDBG and vouchers, the rental vouchers, we need to make sure that we're delivering this message, and we being all of us, so that it means regularly communicating with your, in this case, Senate offices. That we're having a much harder time in the Senate than we are in the House. That we need to build a constituency. We have to find a good champion in the Senate, especially on the Republican side. But even without that, to the extent that we can get your offices contacting your Senate representatives and talking about the importance of the work you do and the importance of the HUD housing counseling assistance. There'll be some opportunities probably to do some stuff around CDBG, disaster recovery as well. But right now, our biggest problem is that we are only at 45 million, as Melody pointed out, in the Senate on HUD housing counseling assistance. That's down from 50 million of the actual allocation last year, and the year before we were at 55 million. So we're losing ground in the House. We are at 60 million, and they'll have to reconcile between 45 and 60. And even if they go halfway, it's still really inadequate funding. So the idea is trying to get the Senate to be as close to 60 million as possible, which is what we've been saying to Senate offices. But if they're hearing from their constituents, along with why it's important, what you do in the field, that's really critical. Melody, do you have anything to add to that?
No, I agree with everything you said. We just got a question that I think would be addressed before E.B. Joki might have to jump off. So we have a comment from someone from Maine asking, so we really mobilized in Maine with all the housing counseling agencies on the call with Senator Collins' office. It was Laura Boxbaum on the call. She asked, was that noticed at all? And she asked, if they're not hearing from other Senate offices, are they hearing from at least those groups in Maine, particularly with Collins?
The word that I've gotten thus far is that the answer is no. I do know that is, and I think Bruce and I know at least some folks on our policy team are strategizing on the members that may be most influential to contact. Maine was definitely identified as a priority, and from what I can tell thus far, our efforts have lacked a little bit in terms of making that direct outreach there. And so it's something that we've got extreme interest in doing, and we want to do in a well collaborated fashion. And so I think, again, both from NHRC and NCRC, we'll see some more guidance and sample letters that folks can be sending, because we really want to make sure that we're making as much of an impact as we can possibly. But no, it has not been significant outreach is the word that I've gotten thus far from that state.
So I should just say that the main groups have done a bunch of things, and that's partly how we got to this point that the visit happened. So this summer there were 2 letters that the main groups pulled together. They had a terrific call with Courtney Young, who was very new at the time, about the housing counseling work that they do, and broadly representative. Some groundwork has been laid, and I think that has been impactful. The problem is it's not enough, and it's especially, I think, where we think it's most important right now is for other members to be talking to Susan Collins and saying this is a priority for us. She's been a little bit of a tough nut to crack, especially since since the main groups are actually quite tightly organized and have been able to really articulate the importance of this. I think we would love to have the main groups continue doing that, but what may be the most impactful at this moment is for other members saying counseling is important for us, and we'd like you to prioritize that. And so what's happening now is that both House and Senate have set their dollar amounts. So what's happening now is that there will be a conference committee, as Melody talked about, between the leadership of the House and Senate. We've had great conversations with the House leadership, Price and Diaz-Ballard, the Democratic and the Republican people, and we'll revisit again throughout the fall with them. But the problem that we have is we're starting with a low number in the Senate, and the problem we need to do is get the Senate to be willing to go for a higher number. So, okay,
Bruce.
So thank you. Yes, go ahead.
Hi, this is Ellie Pepper, everybody. I just wanted to clarify something, Bruce. So when you say other members need to contact Senator Collins, are you referring to other senators?
Yes. Yeah, and it can be people on the committee, but it's fine if it's people, regular senators who aren't on the committee as well.
Okay, thanks.
Good.
Just wanted that clarification.
Right. Excellent. Thank you. Okay, great. And thanks so much, E.B. Joki, for the good work you did with you and your team on the meeting. Very helpful. Let's pivot now to our main topic at hand, this whole question of how you look at partnerships, mergers, and consolidation. And Ellie will take it from there.
Thanks, Bruce. Hi, everybody. So we've had several presentations over the past couple of years that have highlighted innovative ways that housing counseling agencies are creating sustainable funding. And today we're going to highlight ways that some agencies have come together to reduce costs, streamline services, and basically strengthen the overall services that are being provided. So our first presenters are Mike Billnitzer, the Executive Director of Empowering and Strengthening Ohio's People, or Aesop, and Aesop has been on our calls previously. And then also Susan Egan, who is the Vice President of Strategic Development at Benjamin Rose Institute on Aging. And they're going to tell us a little bit about how Aesop and Benjamin Rose came together. Michael and Susan.
Thank you so much, Ellie, and we are happy to be here and tell our story to colleagues. As Ellie mentioned, my name is Mike Billnitzer. I'm the Executive Director of Aesop, Empowering and Strengthening Ohio's People, and also serve as a Vice President on the leadership team of the Benjamin Rose Institute on Aging, our parent organization. And I'm going to turn it over to start us off with Susan Egan, my colleague.
Thank you, and good afternoon, everyone. I'm going to begin by saying just a few words about the Benjamin Rose Mission, particularly as we will come to talk about later. I think the mission alignment between the two organizations was a very key factor. Our mission essentially focuses on advancing support for older adults and caregivers. We do this through our research, which is designed to deepen the understanding of evolving needs of those populations. And additionally, we have worked over our 110-year history to develop innovative, high-quality solutions, and lastly, to promote effective public policies. I would say one of the key backdrops for us as an organization relative to merging is that over our history, we have made major transitions in our service mix in response to changing circumstances in the larger community.
So then for Aesop will be the next slide. Just a little bit about who we are and what led to our partnership with Benjamin Rose and our merger. Aesop's mission is to help adults in all stages of life achieve and maintain financial wellness and housing stability. We're a HUD-approved housing and financial counseling agency. We did merge in 2017. We have two major divisions, suites of programming. Housing counseling, which focuses on foreclosure prevention, which has been our history, and I'm going to give you a little bit of a backstory to our history to lead us up to the merger. We also do home buyers education, pre-purchase counseling, and accessibility modifications and home repairs for older adults. On the other side of the organization, we do financial counseling and coaching with older adults, and we try to give everybody that we see in our financial model and in our housing model financial capability. I'm guessing that formula is going to be familiar to most of you on the call, which is knowledge plus skills plus access to resources. That's kind of the core of what we are trying to do with the majority of our clients. So just some backstory to lead up to the merger. Aesop is 26 years old. We've been a nonprofit organization for 26 years. We're Ohio's largest foreclosure prevention agency, ultimately helping 55,000 people across the state avoid foreclosure across 10 locations. And up to 2012, we had helped 40,000 people avoid foreclosure, 40,000 families avoid foreclosure. But at that time, as the foreclosure crisis was starting to wane or starting to dip, we took a look at our numbers and we realized something very interesting and disturbing, and that's that 40% of our foreclosure clients were 55 and older at a time when they should own their own homes or be close to owning their own homes. They couldn't age in place with any kind of financial stability. So we held some listening tables and talked to older adults to see what were the issues they were facing, and that's exactly what they told us. So as a result of that, to be innovative and stay proactive and try to be preventive, we built a suite of integrated financial education and counseling and coaching services with benefits assessments to help older adults to better age in place. And in 2014, so we had to make a major shift based on our numbers from foreclosure prevention counseling as funds were drying up there, and the numbers weren't there anymore. And I'm sure a lot of you on the call lived through that and had to scramble with things like the hardest hit fund and what have you. So as we built our senior financial empowerment initiative suite of services out in 2014, we began to develop a new network with older adult serving agencies, and the Benjamin Rose Institute on Aging from 2014 to today was a fantastic partner and a natural fit for our work. And with that, I'm going to turn it over to Susan to talk about the reasons for the merger.
Yeah, I would just underscore Mike's point about the working experience that our two agencies had prior to the merger, and I think we both agree that that was a pivotal ingredient in helping us build a positive working relationship and therefore move into the merger discussions with some optimism that this could indeed work well. As Mike has alluded to in his discussion of Aesops was moving more into the older adult space. And Benjamin Rose, when we were working on our strategic planning process in 2015-16, it recognized the growing importance of financial and housing-related issues for older adults and their ability to age in place in the community. So that at the time that our two organizations began to discuss merger, we were already at the place of recognizing the importance of having a financial services model for our clients, and also additionally through working with Aesops had the background of recognizing the excellent level of service that Aesops was providing to clients in that arena.
So to the second bullet point, reason for the merger from Aesop's perspective, to gain administrative efficiencies. Now, as I mentioned, as you all know, around 2014, certainly things were getting financially tighter in housing counseling in Ohio. The hardest hit fund, Save the Dream Ohio, pretty much disappeared overnight. So I know it was brought back in a second incarnation, but it wasn't anything like it was. So we were scrambling a bit. So we recognized that we could gain administrative efficiencies by merging our two organizations. We could save costs on office space, administration like accounting, payroll, and HR, and administrative support. And Benjamin Rose is a 110-year organization that's about, at the time we merged, it's about 10 times the size of our budget. So they had a financial backstop to help Aesop's operations. And since we fit in well, complementary, it made sense that, or it was looking like a merger made good sense for both of our organizations.
I think as we began then to talk about the merger with the elements that both Mike and I have mentioned, that our respective teams really became pretty excited about the notion of building an integrated and complementary suite of services. We also felt here at Benjamin Rose, even though Aesops serves an age demographic that is broader than ours, with the recognition that people do not arrive in older adulthood struggling financially without some prior background of economic history, that for us it was not a problem at all, and in fact in some ways an advantage to embrace within our overall mission an organization that focused on a wider age range. So we again came to this thinking that there could be huge opportunities from the standpoint of impact for both of our organizations by integrating this and creating this complementary suite of services.
So if you look at the next slide, the last slide, the reasons for merger was that slide I would categorize as why. And if that's the why, this slide will be the how. And it's meant to, you know, this is all I could fit on one slide, and I wasn't going to drag you two slides into what happened post-merger and integration, but we'll touch on that in terms of some of the things that on our last slide, the benefits and how to tend to that and make sure that the merger pulls through. But there's a saying that that goes like this: a goal without a plan is a wish. And so we had to have a plan, and I would highlight, this is our work plan, and if you look at the timeline at the top, we had a short period of time to do a lot of things. We started having initial conversations in December of 2016, January 2016, so kind of the pre-merger discussions on does this make sense and is it mutually beneficial, and then as we came together in April, March and April, we started putting together this plan. And you can see all of the things that you really need to go through to execute a merger well. Not only the tasks that you have to do, or the major items that you have to accomplish, but also that this requires a lot of your organization's expertise to pull it off well. So the first part, Roman numeral 1, legal structure and governance. You need your boards involved in making sure that they understand what you're trying to do strategically and get buy-in from them. And then you also, to many of you on this call who are, your oversight is HUD, right out of the gate, that was a high priority for us to make sure that we had HUD's buy-in to move forward and explain the strategy on why we were trying to merge. And then we went into program review, making sure that there was no redundancy in our program mix and that we strategically going forward had the right design. We had to talk about employee transitions and how we were going to handle that and make sure we didn't have duplication there. We had to look at the workspace requirements. Where were we going to be and how were we going to line up and in whose facility? We had to do the due diligence and not only the due diligence, but look at the financial management and how we would handle that. Did we have duplications of financial systems and who was going to take the lead on that? What systems would we use and how would we get everybody up to speed on our financial systems? Fundraising was a big issue for us, the integration of Benjamin Rose and Aesop fundraising, because while we didn't have a lot of crossover, we did have some. And one of the concerns, and I think this is an important point, is an expression that we used at that time is we wanted to make sure that funders didn't see that 1 + 1 = 1. So if we each came with our respective funders to the table, if we had a mutual funder, would they look at us and say, well, Benjamin Rose, we give them $100,000 and we give Aesop $100,000 and they're merging now, so we'll just give them a combined $100,000. It was important to make sure that we knew what our funding strategy was going to be and that we communicated with our funders proactively. Human resources, we had to make sure that we had the support and alignment from our strategy on integrating our staffs. IT, communications and branding, the messaging was critical and if you're considering this, is absolutely critical, not at the end, it's along the way, knowing who you have to communicate with. And things like scheduling the move and aligning your executive staff. When you're bringing together two organizations, you're going to have two leadership teams, and how do you make that work? And then the timing and timeline for implementation, and then the formal adoption of the merger by Benjamin Rose and Aesop's board of directors combined. And that happened in July of 2017. So what I would say in closing on this slide is that it is, again, just absolutely key that you come out of the gate with a plan and that you have your leadership team and your boards aligned together on that plan.
Yeah. The quick point I would make in addition to Mike's is, as you would note from the slide, we had a lot of different staff people involved from both organizations. And this really helped build upon the early working experience our two organizations had that we referenced earlier, and engaged a number of people in the merger process. So there were lots of people who had the opportunity to come to know each other, to understand the merger, to hear the reasons why, to help shape what happened. So this, again, was all part of building the buy-in and really creating a truly merged result. So now
next slide.
Yeah, pitfalls.
So I mentioned this several times in the call, but I can't mention it enough because of because of the population on this call, of obtaining HUD buy-in and making sure that they know your organizational structure and what's going to happen to, your HUD approved status as you merge, and just bringing them with you on what you're trying to accomplish strategically, as well as other regulatory and oversight agencies that you may have to deal with, making sure that they're aware as you move through the process. That is
Mike, can I jump in?
Yes.
Can I jump in
Yes.
just on that?
Sure.
This has come up in other mergers as well. And especially if you're both HUD-approved housing counseling agencies receiving funding. Sarah Jarek has told me that it's very critical that you talk to HUD early in the game, and there's particular ways to structure this and others that may not work as well. And in the mergers of some groups that they've run the risk of losing HUD funding in the process. So absolutely a critical issue there.
Yeah, that's a great point, Bruce. I remember we were talking about where we were struggling was, well, does that mean Benjamin Rose has to get HUD approved, or can Aesop? And ultimately, the way we structured it, Aesop, as a wholly owned or as a subsidiary of Benjamin Rose, kept its HUD approved status and did not have to carry it over to Benjamin Rose. So that's an important first priority.
Yeah, absolutely. And in the first step that Mike referenced on our timeline, when we were working through the legal and the structural process, this was a key piece, I think, both from the Aesop perspective, but also from the Benjamin Rose perspective, because we really wanted Aesop to maintain and actually enhance its strength as an organization through the merger. And had HUD buy-in been lost, that would have been a big negative for us as well. In addition, Mike touched on in the process we went through funder engagement, and I think he's addressed that pretty well. We also were very concerned and put a lot of emphasis on maintaining client identification with Aesop. Again, Aesop, one of the advantages for us as Benjamin Rose moving into the financial and housing counseling world was to maintain the client base. And Aesop has a highly respected brand in that regard. So we ended up working with our team, our IA team that handles identity and branding, and also obviously with the Aesop team, and ended up creating Aesop in effect as a sub-brand. So were you to go to our website or look at any of the promotional materials that are out there, I mean, the Aesop brand is still a distinct and identified brand, but as a member of the Benjamin Rose brand family. Thirdly, as Mike and I have talked a lot about this, a couple of things that we think can really jeopardize a merger being successful relate to trust and shared culture. And so the trust process, as we have referenced, really started with our working together well before the merger and building some relationships. Additionally, the process that we went through, which was much more detailed than we chose to show on this slide, really through engaging a lot of people and working together to find mutually acceptable answers, really helped build a lot of trust between our two organizations. We also, after the merger, went through a series of cross trainings where the Aesop team went to each BRIA department to talk about its work, and then we did the reverse. So our various departments, for example, our research and education, would send team members to the Aesop staff meeting to talk about its work. So that way we were really building individual familiarity, building understanding, and really, we think, planted the seeds for creating, in effect, a shared culture around mission alignment and common program themes. And that, in turn, really set us in a good place to begin to really work to integrate Benjamin Rose and Aesop services, both through a really good referral process, cross-referral, which we now have, and also some new programs that we've developed across the other Benjamin Rose departments in Aesop, which we can certainly talk more about if there's some interest. So in effect, having that not only the post-merger plan, but making it happen. The training and creating cross-functional teams, we feel has really been integral to making what I think both Mike and I and others on our respective teams would see as a very successful merger.
Yeah, I would just close with one last point, which is really kind of an echoing, is that because when we were looking to merge, we had a track record of partnering together and worked on some outside collaborations together. That established trust. When you're looking for a merger partner, that goes a long way when you already have the trust established and you have the working relationships established. I know when we started the merger and acquisition process, we looked at a competitor and that fell apart quickly. So if you're starting to do a search process, recommend you look at who is complementary to your services and who you've worked with and trust. And with that, we thank you.
Great, thank you so much for this. And I just want to point out to people, we will go over the usual hour that we do. There's a lot of content here, and we may go as long as an extra half hour.
Great. Thank you both so much for your time and for your presentation. A lot of really great information there. Our next presenter is Susan Kottner. She's the Executive Director at Affordable Housing Partnership in Albany, New York. And she's going to tell us about their collaboration process with the local land bank. Susan.
Thanks so much. So again, I've got 3 stories I can share of opportunities to collaborate in Albany. The first one on the next slide is, again, that whole kind of echoing what you just heard, this consolidation of complementary programs, also known as the stars are aligning, right? So this is story number 1. The Albany Community Land Trust was organized in 1987 by groups or folks coming out of United Tenants of Albany looking to help preserve and create affordable housing. They have a fabulous acquisition and rehab program targeted for homeowners, but over the years we've really developed a rental housing portfolio as well for needed affordable rental housing. The partnership was created a couple of years later as a lending consortium to provide mortgage loans to low-income first-time homebuyers, but also to not-for-profit organizations like the Land Trust. So folks who couldn't qualify for conventional loan products. That was in the ancient days when interest rates were about 10%, and they didn't know what a down payment assistance program was. So we got organized with 16 banks to provide good mortgage products. The partnership necessarily had to have a regional board of directors because we did want to work throughout the capital region. We had lenders on our board. We had government officials on our board. We had housing not-for-profits on our board. The Land Trust, on the other hand, was very much neighborhood-based. Their territory was the city of Albany only. They have a remarkable board. It's comprised of residents, homeowners, and folks engaged in affordable housing activities here in the city. So a different group of people, really strong board. We were at a point when we were both probably kind of 10 to 12 years into our life, having some major turning points in both organizations happening at the same time. So for the partnership, after 10 years of making affordable loans through this lending consortium, CRA changed a little bit, and now the lenders were getting more credit if they made direct loans themselves to first-time home buyers. And by that time, 10 years in, they had good loan products. Their rates were low. They accepted down payment programs and that type of thing. So we were no longer participating as a lending consortium. We were winding down our operations in that regard. We also had a couple of REO properties that needed some maintenance work and property management services that the Land Trust was experienced in providing. The Land Trust, their executive director, they'd had a series of directors coming in a couple years at a time, so there wasn't a lot of stability there on the staff. So it was an opportunity for us to really see how we could potentially partner because we had complementary programs. The Land Trust needed the housing counseling services that we offered, and we saw, after making 10 years of good low-income affordable loans, that lending activity wasn't having the impact that we really wanted to have on low-income neighborhoods. In other words, we were helping first-time buyers move out of the city, and we were really committed to community development and the work that the Land Trust was doing. So yes, moving on to the next slide. So we pulled together a consolidation committee with board members from both organizations. And importantly, that group was led by one of the founding board members who was common to both organizations. So we were really fortunate to have a very well-respected board member help us go through those discussions. We considered the gamut of how we could partner, from just simply having a contract for services between the two organizations. But we realized that where we were both at, financially, the partnership at the time was perceived as the stronger organization because we were making money from our lending activity. The Land Trust was in a more fragile kind of development project to development project type financial scenario. So there was some perceived benefit to trying to save money on operations. So we decided to merge our operations so that the partnership was the employer of record for all the staff for both organizations. Now we've grown. We're now a huge staff of 10. These are two small organizations that were talking to one another at the time. But we have found that that has saved us a lot of time and effort in terms of managing payroll, benefits, and that type of thing. 2 years later, we both moved into the same office space so that we now share offices and have one lease, one shared phone system, and that type of thing. Again, just saving a lot of time and effort in terms of just those administrative overhead issues that you have. But probably the smartest thing that we did was to retain our separate boards of directors. And I think, again, we had 10 years of knowing one another. Again, the partnership knew very well what the financial situation was of the Land Trust because they were one of our big borrowers. So we were very comfortable in keeping us separate. We wanted the Land Trust to continue to own and maintain the real estate on their books and keep the partnership programs different. We did agree to a relationship so that the Land Trust board appoints 2 members to the partnership so that they have say and impact and influence on staffing and office decisions and that type of thing. Programmatic decisions are still retained, if you will, by the 2 separate boards. And again, that has worked out pretty well for us. So moving on, again, just in terms of why it's been working so well is, again, we have that same corporate culture in that we were both organized out of a desire to impact, housing affordability in our community. We had that 10-year working relationship so that we could build that trust and working relationship. I think we've both benefited by keeping separate boards of directors. Again, this Land Trust board, that's a very community-based, has really kept us grounded in terms of the work that we do, and that we've really benefited from a regional board that engages other not-for-profit organizations so that we can continue to collaborate with them on a region-wide basis on regional issues. Having the bank members on our board has been helpful for keeping the dialogue flowing with them, and then obviously local government as well. So all in all, I think that worked out really, really well. All right, so I want to pivot to our second example here, which we were not as directly involved in, but I wanted to share it as an example. And so the subtitle to this is The Merger of Necessity. In our office space, we work out of a business incubator in Albany. Across the hall from us is our local community loan fund, or CDFI. and we all moved into this space at about the same time. The space was managed by an incubator, a business incubator, and this was their sole project. They began a collaboration in that the loan fund, which was making loans to small businesses, some of whom were occupying the space here at the incubator, they saw the benefit to jointly provide programming in terms of training and technical assistance to those small not-for-profit organizations and small minority MWBE businesses that they were trying to encourage and help grow and that type of thing. The business incubator was not making a ton of money from the rents they were charging here. The government money they were getting was not being as forthcoming as it had been. So they began a series of discussions with the loan fund. And essentially what happened was that the incubator became a membership organization, and the Community Loan Fund, the CDFI, became the sole member of the incubator space. So that now the CDFI, the stronger organization, really is the controlling entity, setting up that, again, they kept an independent board of directors and managing the program through the incubator. And that actually has, again, worked out really well to, get almost to the merger, the final, if you will, threshold of merger, but stopping just short in terms of completely merging operations, about retaining the separate boards, again, allowing to, some real specialty members, if you will, in the incubator board, but a much broader community-wide, region-wide board for the CDFI that's worked out well to benefit both groups. All right, so moving on to my third example here, the last slide. I will tell you that we've also had an opportunity to really mess up in terms of a merger misfire, I'll call it. And this was something that was recommended to us by a major funding source. We, at the Land Trust, I can see outside of my window another local neighborhood-based organization, and the funding sources were saying to us, look, you guys really need to pull together, join operations, become a much stronger community development corporation, and we'd really support you in doing that. So we didn't have that 10-year history. We didn't have that same corporate culture, if you will. There were a couple of board members on the Land Trust who were known and had been board members on the neighborhood-based group, but that had been a long, long time ago. And there really hadn't been a lot of joint efforts together to combine programming and that type of thing. In fact, it's pretty easy to think of the two groups as being competitive because, they're trying to do community development activities in kind of the same couple of neighborhoods in the city of Albany. So the real deal killer for us was when the funding source required that were agreed to pay for, let's put it that way, agreed to pay for a third-party attorney who was tasked with really facilitating the merger discussions. And unfortunately, his approach to it was, I'm not going to spend a lot of time with you guys unless you agree up front at the beginning of the process that you will merge at the end of our discussion. And so that totally blew everything up, and we all walked away. So again, I just wanted to provide that example of what not to do, and that it really didn't really help us much. And in fact, we still have a lot of hard feelings about that whole effort, even 5 years later. So don't recommend that approach. So that's what I've got from Albany.
Thanks, Susan. That's really helpful. All of the different things that you spoke about, especially the misfire. Our next presenter is we're gonna hear from is Brigitte Olson. She's the COO at DevNW, and she's going to tell us about the merger of Williamette Neighborhood Housing Services and Neighborhood Economic Development Corporation. Brigida.
Great, thanks so much. Again, I'm Brigida Olson. I come from the half of Willamette Neighborhood Housing Services, which is now a whole, Dove Northwest. We are two community development corporations. NEDCO started in Lane County in Oregon and since expanded their service area, and Willamette served a 3-county area. And it was really through our strategic plan in 2015, through Willamette Neighborhood strategic plan, that we realized that we wanted to organize ourselves differently. Both organizations, NEDCO and Willamette, had been around since almost the beginning of time. NEDCO has been around for over 40 years and Willamette Neighborhood 28. And what we wanted to do is really think about how we could have broader, better impact in the communities we serve. We also didn't have a problem with the executive committee and retirement. So Willamette Neighborhood Housing Services executive director at the time was starting to think about retirement. We knew and had been working with NEDCO for a very long time, and so it was very much natural that we would reach out to them along with other organizations to see if a merger would make sense for the two organizations. Next slide. Again, we didn't want to duplicate services in service areas. We really were thoughtful through our strategic planning work and through the merger, was to really think about how can we do our work differently. Organizations of smaller scale often can only address one small problem, where through our merger, we're hoping to expand services, have a lot of complementary services to better impact the communities we serve. We, Willamette Neighborhood, spent over a couple years talking to other organizations and seeing who might be or what organization might be a good fit for a merger, and kept on going back to NEDCO. And I'll return to that in a couple minutes. If you want to, next slide. So with the greater impact, we're talking about having the development of quality affordable housing for both renters and first-time home buyers. We have lots of different lines of business within our organizations, and both organizations had complementary services. So now we were able to hire and expand our development team from 1 person to now 3 to serve a much bigger region, and we have a lot of development in the pipeline and hope to be doubling our portfolio for years to come. We knew that partnerships for healthy communities are really important, and for our tenants and for neighborhood organizing and planning. And so being able to serve neighborhoods well and have complementary services are important. Next slide. NEDCO had done a lot of community economic development work, and we were looking and doing work targeted in neighborhoods and really wanting to bring in all the different tools we have to help create neighborhoods of opportunity. And so working in commercial development, supportive affordable housing, having lending services are critical, and having partnerships with other local organizations is really important. And so working with NEDCO to help develop and improve neighborhoods is something that they've done in Springfield in the past, and something we're going to be doing in Corvallis, Oregon, years to come. They also have a lot of tools from lending. So NEDCO has an affiliate organization called Community Lending Works, now Dove Northwest. And so we have a lot more tools in our toolbox to help first-time homebuyers, help small businesses, help folks build their own credit through our CDFI. And then financial well-being programming and asset building. Both organizations offered a diversity of services in financial well-being, but we didn't offer services in the same area. So at the next slide, I'll show you a map. NEDCO historically had been serving Lane, the yellow is NEDCO, the former NEDCO, Lane, Marion, Clackamas counties, and then Willamette was the blue area. Now we're all purple, Dove Northwest. But NEDCO skipped over our service area, and so now we have an ability to better serve and impact 6 counties collectively together. Both organizations, through the financial well-being programming, had worked for over 16 years together, recognizing that there was that skip. So we were thinking about ways that we could market differently, ways that we could collaborate and have a shared staff, et cetera. But through the merger and really evaluating how to better impact communities, it was decided that having one organization with 4 different offices makes a lot more sense. Next slide. So expansion of our financial well-being services. The NED side had many more tools than we had in Willamette Neighborhood Service Area. So now there's services in Spanish, diversity of classes, including financial foundations, couponing, wills and life planning, along with individual development accounts and IDAs, and down payment assistance, student loan counseling. So we have so many more tools than we've ever had in order to help individuals build wealth, purchase their first house, and stay and retain home ownership. Next, merger considerations. There hasn't been any financial benefit necessarily for our merger. We got married. We used the marriage analogy on January 1st, and we've increased a lot more staff, which is fantastic. And so, it was early decided that we didn't have to worry about having 2 executive directors. So that's great. We've been able to add on staff, including the development staff. We have 2 grant writers where many of the senior management in the past had got the opportunity to do a lot of grants internally. And we're continuing to expand our service area. Funders are also looking at us and understanding that we have a big concentration of the population in Oregon, which is fantastic. So we had amazing dedication from foundations to help us explore the merger. It took us about 3 years to really ponder whether we should get married. We did our due diligence. We had task groups, just like many of the other examples earlier, where our board came together and formed merger task groups. Our staff came together and formed merger task groups to really identify if it made sense to merge. About a year ago, the boards, or I guess 2 years ago, both the boards agreed that it made perfect sense. And then this past year, we've been doing a lot of internal work as far as how to create a new brand, how to create economy of scale, how to let communities know that we still serve them and we have more tools in our toolbox than ever before with a new name, et cetera. Both boards, the governance is a key component. And so our board members, we had joint board meetings for a number of months leading into the merger. So each board could recognize the operating work between both organizations and boards. And again, it was very much similar organizational culture from a governance standpoint and a board standpoint. And quite honestly, it's some of those little things. When you're thinking about organizational culture and seeing what your colleagues will be wearing matters. And so from the Willamette side, we wear jeans, and we had historically, the NEDCO side didn't wear jeans and they had much more formal attire. And it came down to like the simple questions of like, will you consider changing your dress code so that jeans are allowed? And making sure that we spend a lot of time making sure that staff understand their roles and understand that we're totally flexible, and one way that one organization might have operated might be shifting and change, and we need to be as flexible as possible. Next. So, we're 11 months into the actual merger. It took us at least 3 years to evaluate. And, I think implementation will still take a year to 2. We needed, of course, additional financial resources and people power. Don't underestimate that. I think we're still doing our regular jobs. On top of that, we're merging two really strong, healthy organizations, and that takes a lot of time, thought, and you need to be very flexible and have a sense of humor, because this is hard work. And understanding that at the end of the day, the people we serve are having many more additional resources in their toolbox, and so we're able to help new homeowners get into homeownership, because not only are we teaching them from a housing counseling standpoint, and we have student loan counseling, et cetera, but now we have more staff to build community land trust homes, so there's actually housing stock for folks to get into and purchase and help build wealth over time. So it's been a ton of work. It's very exciting. And I think we still have a couple more years to really fully feel like we're one organization. We just launched our name 2 months ago, so I still answer the phone in the wrong organizational name sometimes, because it takes time. Thank you.
Great. That's really helpful information, and I think it's important to highlight the need to be flexible and have a sense of humor. I think that's important. So thanks. And last, but certainly not least, we have Jerry Nagy with CEO. He's the CEO of NeighborWorks Community Partners in Rochester, New York. He's going to talk with us about the process of bringing together several organizations providing services in Western New York. Jerry.
Great. Well, thank you. Again, I'm with NeighborWorks Community Partners, and if you've somewhat paid attention to Western New York, you'll have noticed that our local organizations are going through a bit of a rebrand and name change, so that we're more of one big happy family, as it were. Just to give you a little bit of history around NeighborWorks Community Partners and how we came to be. This effort started really for us as an organization about 10 years ago, and I'm fortunate to have not been part of the early process, so that gives me probably the freedom to air all the dirty laundry, as it were. But what really happened is we had a group of NeighborWorks organizations that kind of looked around the housing and community development landscape, particularly focusing on other NeighborWorks organizations, and looked and noticed that while they were independently strong organizations having an impact in their communities, when they looked at the numbers and standing on their own, they were still significantly smaller than other organizations, particularly other NeighborWorks organizations. And there was a belief and an understanding that, over the long term, they needed to figure out how to scale up and what are the ways that you can sort of do that. So sort of the lore, I guess, or the story around what happened is these organizations were all at a NeighborWorks convening of some sort, and after the meetings for the day had ended, they were all having drinks and sort of talking shop, and recognized that they needed to figure out ways of working together. And so, like many of the other stories that we've heard so far, they literally went through years of trying to figure out what the structure should look like, who should be involved, who should not be involved. And what we ultimately landed on was the organization that we have today, where NeighborWorks Community Partners is effectively the parent organization, and we have affiliates in Buffalo, Rochester, and Niagara Falls. What I think is particularly interesting around the organizations that were involved for this merger or this partnership is that where other folks have talked about complementary programs, we actually really had mostly competitive programs. So when you look at what we were able to offer in each of the cities, all of the organizations involved did pre-purchase housing counseling, for example. Everybody has some sort of rehab program. Everybody does a little bit of lending with a revolving loan portfolio or a CDFI. And so if we were all in one city, this may have been a very different result, whereas being spread out, so Buffalo is about an hour and 15 minutes from Rochester, and is about 30 minutes from Niagara Falls. Being all sort of separated like that, but offering the same programs, gave us an opportunity to look at how we could then scale up already existing lines of business. So for us, being having competitive programs was more of an advantage, I think, than if we had either all been in the same city, or if we had been spread out geographically and all offering very different programs. So we were really felt as though those programs could then be scaled up. Just like everybody else, you're looking also for the efficiencies, sort of your back office stuff in terms of finance, HR, payroll, all that kind of stuff, getting it all under one system, using the same technology, using the same phone systems. That's where, for us, especially being geographically dispersed, was not just important, it was really critical to whether or not this becomes successful for us. But then also, how can we be more efficient and scale up programs? If you're doing housing counseling in each of the cities, how can you utilize that to your advantage to do more and create more homeowners? So I think what really makes us unique is the way we're structured. So we have NeighborWorks Community Partners is the parent organization, and to be honest with you, from that perspective, NeighborWorks Community Partners itself really doesn't offer any programs per se, although it does pay my salary, so that's exciting. It's really the local organizations that still maintain a lot of the program delivery. So NeighborWorks Community Partners is the sole partner of the other organizations, being Westside Neighborhood Housing Services, Black Rock Riverside, Niagara Falls NHS, and NeighborWorks Rochester. So each of the local affiliates is still an independent 501c3 with a local board of directors. And so they all have all of the both the perks that come with being an independent 501c3, but also the responsibilities and requirements that come with that. So we really have intentionally designed the organization to both be local and regional at the same time. And that was really important for the founding members of this organization, because the four locals were always so neighborhood based, and really in a best case scenario, they were citywide, but two of the four were certainly still neighborhood based. The other two were offering some of their programs citywide. So they really wanted to maintain that ability to have a connection with the community, but also be able to then scale up programs, offer them bigger and better ways, and hopefully expanding services out of the urban cores of Buffalo, Niagara Falls, and Rochester. So that is, for us as an organization, definitely a benefit. The way it really works for us structurally is we have, and in terms of the governance per se, each of the local organizations maintains the same number of seats on the parent board of directors. So that is in part, in a way, for the organizations to build trust early on. You're bringing together four very different organizations and giving everybody an equal seat at the table, I think made things a little bit easier. But it also, more practically, especially today as we're years into the process, it allows for a good flow of information between sort of the regional and the local. The two sets of boards are really set up for thinking about things very differently. So the parent organization and its board is really focused on the overall health of the organization internally, and making decisions based on what's best for everybody. It's also charged with looking at things across Western New York. So what are the programs and services that we should be offering to meet the needs of Western New York, and not just a certain part of the city of Buffalo, for example. And by contrast, the local boards sort of have the opposite. They're looking at what's going on the ground and providing that information back up to the parent organization. As it stands right now, each local board appoints board members up to the parent. Right now, all of those members are currently also members of the local board, so that does sort of require your volunteers to attend multiple board meetings every month. That doesn't always have to be that way, but that's how it is right now for us. But that also allows a better flow of information, where if you're going to a local board meeting and a regional board meeting, you're providing information back and forth and helping people understand what's going on at sort of both levels, and that part of it's been really great. It was definitely a long process for us to get here. We're actually 5 years into the official merger itself. 5 years on January 1st, so we're getting there, and we're still dealing with a lot of the hangovers, and it's interesting to hear some of the lessons that that others have gone through, and maybe it would have been great for us to hear 10 years ago, because some of the things that were talked about early on, particularly around planning, not just getting up to the merger itself, but really what happens after, was a big thing for us. I think we went through a lot of debate and focused a lot on sort of what I call getting to the finish line, and that being signing on the dotted line that we all agree to create this parent organization and give up a fair amount of control to it. There was a lot of negotiation that needed to go on for that, and to get to the finish line. And I think that's where a lot of the energies were focused, and sort of less focused on what happens after you sign on the dotted line. So how do you take all of your individual programs that have been operating in their own way in each of these cities for the last 30 or 40 years, and then get them to operate in the same way, especially when each of these programs operate in a way that isn't necessarily wrong. It's just different than the way the others are doing it. And then you have to spend a lot of time, which is what we've been doing recently, of sitting around the table going, well, how should we do housing counseling? How should we do lending as one unified organization? So we lost a lot, I think, of energy in that space in terms of the lesson learned of not really thinking through what happens after you fully sign on the dotted line. But one of the other lessons I think for us is, and I've heard this from some of the other folks who've gone through the mergers, is strategically thinking about who you want to merge with. This really was an organic conversation, and it was kind of who wants to be part of this in the early days, and not thinking more strategically, resulted in, I think, a lot of hurt feelings by the time that we did get to the finish line, and that impacted us internally as an organization, but it also impacted partnerships and relationships externally that we've had, folks that were part of the process and at some point fell out. That's a struggle for us as an organization, and we've had to spend some time reacquainting ourselves with some organizations. And I think the other big thing that I would point to in terms of a lesson learned for us is really paying closer attention to the people and the cultures of the organizations. I don't think that was a big priority. I think there was a lot of work, again, put on to getting to the finish line, so to speak. And as I touched on earlier, doing all of the things that we had been doing in our own world, in our own way, none of which was necessarily right or wrong, meant that we've spent a lot of time trying to figure out how best to do things, and really without doing a fair amount of sort of that team building or getting folks into the same culture space, we lost a lot of time and energy, and I think that early on resulted in some challenges for the original CEO, and then it was really to a point that when she left, there was some real concerns about whether or not this would even survive if it got that bad. But I think to the credit of the people that were here, particularly on the board, they all stepped back, took a year, and hired a consultant to do some of this work. So we were really without a CEO for a little bit more than a year as they figured out, is this still worth it? And if it is, how are we going to do it? And I think that's great. That's allowed me to come in and start thinking through how we can get to those scalability and efficiency things. They were able to make some progress on some of the back office functions like finance, like on HR and hiring processes, stuff like that. But we're still aligning our programs. We're rebranding all of the organizations, and we're just now starting to see things get lined up the way that I think they had hoped would happen sooner. And I always sort of tell people internally, especially the staff who struggled through so much change over the years, that, we're probably 2 years behind where we thought we would be. You go for a year without a CEO, that's hard. And then sort of that transition into a new CEO, everybody's got to get to know each other kind of thing. So now we're really starting to recognize those efficiencies. We're investing heavily in a rebrand and marketing. We're investing heavily in technology, in part because that helps us internally as an organization because we are geographically spread apart. So we rely on things like video conferences. We try to do in-person meetings, but that's a lot of travel for folks. We also think that technology provides us a competitive advantage over the long run as, more and more younger folks get into our programs. They don't necessarily want to meet with us in person or pay every bill by coming in and writing a check. They want to just do it online. So things like that we're starting to really focus on and be more, I guess, progressive or cutting edge, as it were. So it's been a long process, I would say, but we really feel like we're in a good space now, especially as we're starting to see all the things that we've talked about in terms of efficiencies and scaling up starting to come through. And, the staff really feel great about what we're doing. And it's just, it's an exciting time to be here.
Well, that's great. That's great, Jerry. Thanks so much. I want to tell everybody that the Harvard Jort Center for Housing Studies actually did a paper on this exact merger called In Pursuit of Union, a first collaborative merger effort of housing organizations in Western New York. I put a link to the paper in the chat box if people want to take a look at it. I have read through it a number of times, and I think that it's a really informative document, gives some really great feedback on what worked and what didn't work. And I'm also happy to hear that ultimately, because this was published in 2017, that since 2017, the merger has continued to move forward. And the other thing I want to tell everybody, all of the presenters today that spoke about their experiences have been gracious enough to say that if anybody wants to pick their brains, ask them questions, they've provided contact information. It's in the webinar, and you should feel free to reach out to them if you have any questions or thoughts that you want to bounce off of them. And I think with that, I'll turn it over to Bruce.
Great. So one question I have for the panel is there funding to pay for the development costs of these kind of mergers? And I mean, we know there's interest among some of our stakeholders relationships, but were you able to find independent funding to pay for the costs that are involved in planning and implementing?
This is Brigida, Deb Northwest. Yes, we were able to get quite a bit of foundation support from Oregon foundations to help support sort of the evaluation and then implementation. A key component to that is to start those conversations early. So we let them know what we were pondering. We shared our strategic plan with them when we completed it to let the foundations know this is something we're trying to pursue. So they were already on our team, invested in seeing this through with us, which was fantastic.
This is Melody. Sorry.
Sorry, go ahead.
No, I was just going to go through a few questions that our audience asked, but you can go ahead.
No, this is Susan Egan. I was just going to share that we did not seek funding for the work that we did. Essentially, Mike and I, as well as other team members, put in a lot of time as we moved along. But I would say in this particular community of Greater Cleveland, and I speak now as a former funder, there are several funders who tend to be supportive of providing such financial assistance to support mergers.
Okay, great. This is a question for the whole panel. Have any of you had to lay off people through the merger or consolidation process?
I'll start. This is Mike with Aesops Benjamin Rose. We were very deliberate about not doing that, you know, unless it was absolutely essential. And because, as all of our colleagues spoke about, being deliberate and strategic about this approach, we did not have to do that. In fact, we tried to let people know that while employment is at will, we're going to do what we can for a solid year to make sure everybody is secure until the integration is complete, and then strategy takes over and things can change. But we wanted people not to associate, our staff not to associate the merger with layoff.
And this is Susan Egan, and I would just add that we, over time, have created some, I'll call, sharing across the organization, so that there are a couple of Aesops positions that are now partly shared with the rest of Benjamin Rose. So part of our intention, as we did the HR share to kind of audit from both ends, was to think about possibilities where we could do that kind of sharing that would both retain the Aesops team and enhance what we are able to do with the rest of Benjamin Rose.
Thank you. And then finally, oh, sorry.
Deb Northwest, we've just added a lot more positions because we have scale now, which is fantastic, and we've been able to recruit nationally because of our bigger geographic footprint.
That's impressive.
And this is Jerry from NeighborWorks Community Partners. We actually did reduce staff twice. And that's been a contentious issue for us as an organization. Early on, promises were made around funding and staff resources and allocations that ultimately we could not honor those promises. But from an organizational standpoint, there were places, particularly at the senior management level, where we had basically too much management and not enough staff offering programs. And so it was tough, and I'm glad to be through it and hope to never do it again.
Yeah.
Okay. And the other question we had was, there are several small agencies nearby them that have closed down housing counseling or cut back on services. And this organization wouldn't necessarily merge with these agencies, but they are curious if they would be able to manage some certain services for them. For example, the oversight, administration, training, quality control, and fundraising. Are there any examples where partner agencies can do this for another organization, like a franchise agreement, but only for housing counseling?
I couldn't speak to that.
Yeah, I can't. This is Mike. I couldn't speak to that. I don't think Susan or I can speak to that. Interesting idea, but not that I have seen that model.
Oh, that's it on questions. So thank you very much. This was a fascinating session. Thank you for all the contributors. We're going to move quickly to the end. And just a quick reminder to join your membership dues if you haven't joined already, and to renewal if you're up. We have we're kind of at the end of the year, so I'll send out my annual notice about be sure to build us into your budget for 2020 and make sure that we're part of your plan. We continue to do the work we do, and the membership dues provides us with flexibility and discretionary funding that allows us to do the lobbying and work that other funding sources don't provide for. So very appreciate that a lot. We're planning on our next call on the 21st, and keep an eye out on the leaders list serve for what the call details will be. Thanks, everybody.